Accounting Standard 29. Till now we have completed many standards in Group 1 and Group 2. Now we are going to discuss about Accounting Standard 29, which deals with provision, contingent liability and contingent asset. This is very small standard and it is also important. So a provision is a liability which is measured using substantial degree of estimation. That is, a provision is treated as a liability and also it is something which is a degree of estimated in amount. So it means a provision, it has a characteristic of liability, but we can't treat it as a real liability because the reason is there is some estimated amount that we are going to incur a loss. So there is a estimation part, that's why we call it a provision but not a real liability. Now provision relating to liabilities only, it deals in Accounting Standard 29. So friends, we calling the provision, and provision is dealing with Accounting Standard 29. So which type of provision it deals with Accounting Standard 29 means a provision which is dealing with liability but not assets. It is going to club into Accounting Standard 29. For example, provision for creditors, provision for loan, all this comes into the Accounting Standard 29. But what are the provisions which is dealing with the assets, like provision for depreciation and provision for bad debts, provision for impairment loss, all these are dealing with assets. That's the reason these are not considered into the Accounting Standard 29. So conclusion is, the provision which is dealing with liability, it is comes into the Accounting Standard 29, and the provision which dealing with assets, it does not deal with Accounting Standard 29. So let us see from once again. A provision is a liability which is measured using substantial degree of estimation, and provisions relating to assets like provision for bad debts, provision for depreciation, provision for impairment loss are not covered under Accounting Standard 29. And Accounting Standard 29 only deals with those provisions which are in the nature of liability. So already we have seen that the provision deals with only liability comes into the Accounting Standard 29. And we said that provision which are in the nature of liabilities. Then what is the meaning of liability? Till now we have done very standard way, many standards, and also we have did many problems under Group 1 accounts. But anyway, there is no definition for liability. First time in Accounting Standard 29 there is a definition for liability. The meaning of liability is a present obligation of the enterprise as a result of past events, the settlement of which required outflow of economic resource. So friends, here liability means it is a present obligation of the enterprise as a result of past event. So for example, take a example of creditors. Here creditors is a liability. How it came as a liability means it has a present obligation. So for creditors we have to pay amount, so there is a present obligation, and which is result of past event. So how the creditors amount is risen, there is a past event for that, that is whatever we have purchased and whatever we have not paid the amount, so it is treated as a creditor, and the settlement of which requires outflow of economic resource. So for creditors we have balance sheet amount is suppose 1 lakh, so we have to pay 1 lakh, there is a outflow of economic resource. So cash is a outflow of economic resource. So creditors is meeting the definition of liability. So let us see once again what is the meaning of liability. A liability is a present obligation of the enterprise as a result of past events, the settlement of which requires outflow of economic resources. Example, creditors and loan. Loan also there is for loan there is a present obligation to pay loan, and there is a result of past event. So some upon a time we have taken a loan from bank, so it is past event. And there is also present outflow of economic resource, that is we need to pay loan amount, consider 10 lakhs. So there is a economic resource which is going from our enterprise. So loan also meeting the definition of liability. So we can treat the examples for liability, creditors, loans, whatever which is satisfies the definition of liability, we can treat as a liability. So friends, we have seen the liability definition. Liability is a present obligation of the enterprise as a result of past event. Here, what is the meaning of present obligation? Here, present obligation means an obligation is considered as a present obligation if based on evidence available. Its existence on the balance sheet date is considered probable more than 50%. So present obligation means there is a present obligation based on evidence available. So whatever the evidence available, you treat it as a present obligation. So, suppose treat as a creditors, there is a present obligation which have evidence. What is that evidence? We have purchased goods, so whatever the invoices, these are the evidence available, and its existence on the date of balance sheet. So while we are preparing balance sheet on the 31st March, there is a existence of this obligation, and there is a probability for the payment of these more than 50%, then it is treated as a present obligation. And what is the possible obligation? Here, an obligation is a possible obligation if based on evidence available, its existence on the date of balance sheet not considered probable less than 50%. So what are the on the balance sheet, then if there is existence of the evidence available, and for this there is a probability of less than 50% or equal to 50%, then we can treat it as a possible obligation. Now consider this example to understand what is the liability and what is provision. Now I am a manufacturer of watches. I am giving warranty to my customers on those watches. So today I sold 1000 watches based upon my past experience. So there is a damages I returned by the customer to reset their damages for 10 watches. So how I determine these 10 watches means it is based upon my past experience. Now I have to create here provision, that is provision for 10 watches, and each watch rupees 1000. So I kept 10,000 as a provision for damages, and on the balance sheet date there is a provision for damages 10,000 and some creditors, it is a real liability, so it is shown at 1 lakh. Now what is the difference here means, here creditor there is a real liability, and the provision for warranty, that is provision for damages, whatever those provision can be understood as a liability having uncertainty towards amount and timing of outflow. So because of these two conditions we call it is a provision, not a liability. Now there are some conditions to recognize for provision. If the following three conditions are satisfied, then we can recognize provision. Those are: there is a present obligation as a result of past event. So whatever there is a obligation, it is based on the past event. For example, take as usual example, that is creditors, because you have purchased it meanwhile, so you have to pay amount. This is a present obligation that is based on the past event. And second condition is it is probable that outflow of economic resource is required to settle the obligation. So here probable means there is a confidence of more than 50% that there is a outflow of cash. Now here it is probable that outflow of economic resource is required to settle the obligation. So consider same example, for creditors there is a obligation to pay money, so there is a outflow of economic resource which is cash. And the third, that is, it is reliable estimate can be made for the amount of obligation. So for this there is a estimation for the whatever the provision you have made. For example, now you are creating whatever the amount you have to receive, so there is a, you are going to make a provision. In before example we treated as a watches, so there is a damages for 10 watches, and for that you are creating provision, so there is a estimate amount. In that example we have taken 10,000, that is 10 watches into 1,000, so 10,000. So to satisfy this also, to satisfy that, there is a reliable estimate can be made for the amount of obligation. So 10,000 is a reliable amount which is estimated for that obligation. So these are the three conditions. If these three conditions are satisfied, you can recognize provision. And provision can be created out of contractual obligations and legal requirements, past practices, or to maintain good relation with customers. So for these reasons you are maintaining provisions in your balance sheet. Now till now we have seen what is provision. Now it's time to know what is contingent liability. Next, what is the meaning of contingent liability? Here we have divided into two. These both treat it is a contingent liability. First we are going through first, that is, I have wrote there one. It is a possible obligation. Here the possible obligation, already we have seen what is the meaning of possible obligation. Here the possible obligation means an obligation is a possible obligation if it is based on evidence available. Its existence on the balance sheet date is not considered as probable, that is less than or equal to 50%. So possible obligation means less than or equal to 50%, which is evidence available on the date of balance sheet. So here it is a possible obligation, the existence of which will confirm by occurrence or non-occurrence of one or more future events. So we have no clarity for there is to make liability or not, because there is a less than 50% chances on occurrence or non-occurrence of such a future event. For that reason you have treating it is a contingent liability. Now when we can treat it is a contingent liability, here it is a present obligation which could not be recognized because outflow of resource was not probable, and second is a reliable estimate could not be made. So friends, if these two conditions satisfies, then we can treat it as a provision, because there is a event and there is a outflow of resources and there is a reliable estimate. Because there is the word not here showing it is a difference between liability, the contingent liability and provision. So here treat it is a contingent liability because there is no outflow of resources, and we cannot say that there is no outflow. There is a not probable. Here not probable means less than 50% chances. Because of this reason we call it is a contingent liability, and we can't estimate the amount which is going to pay. For these two reasons we call it as a contingent liability. Now on second part, let us see some examples. Not only second part, it also includes first part also. Now consider this example. There is a factory, and in this factory there is a manufacturing of medicines, and meanwhile there is a wastages while producing medicines, and all the waste is dumping into river. Because of this reason the river were spoiled, and what are the people they staying, they complained to government that the river was spoiled because of that factory, so we need compensation. And till now there is no act for the spoilage of this river, so there is no real liability. After that, because of the complaint of public, they may collect the compensation, so there is no uncertainty whether the company pays or not, doesn't pay. For this reason we treat it as a contingent liability. And consider next example. Here in this example there is a two. One is how you deal with provision and contingent liability. In a SEZ there is a 10 factories. Because of this there is a spoilage of environment. Here those boxes are treated as it is a factories, and there is one my factory, that is a big factory, and because of their spoilage of environment, and there is also Environment Act at present. Treating this Environment Act, there is a compensation have to pay all the factories to government. So government made a penalty on those 10 factories for rupees 10 crores. It is jointly and severally. Here what is the meaning of jointly and severally means, if one doesn't pay, another should compensate that loss. So however all these companies are any of 5 or any one should compensate 10 crores to government of India. So they have to give money to government of India for whatever spoilage they occurred for these factories. Now here one company paid 1 crore. So it is not paid, but there is an estimation. It means that factory person goes to a lawyer and asked him whether there is a liability for him for that factory. So the lawyer told that yes, you have a liability. It may arise for 1 crore. For there is a probable for 50%. For this reason he made a provision that he have to pay 1 crore to government of India. So he made a provision, and balance 9 crores should be borne by another factories, that is remaining 9 factories. But it is a jointly and severally policy. If none of they pays, the only factory that whatever 1 crore has made, that is paid by the one factory, it should also borne loss of 9 crores. For this reason, so we cannot say whether they pays or not pays. There is no outflow of resources at present, and there is no reliable could be that is estimation could not be made for a cash how much is going out. For these two reasons, if another factory does not pay 9 crores, that borne by one factory, that is who is paid 1 crore, so that amount 9 crores, it is treated as a contingent liability for that factory. So in this 10 crores there is a division. 1 crore whatever the factory has to pay, it is treated as a provision for damages, and the another, that is 9 crores, another factory people doesn't pay, so however it should be borne by him only. So that's why it is treated as a contingent liability. So this is the example for contingent liability and also provision. Before going to learn what is the meaning of contingent liability, there is a question for contingent liability, that how you will recognize a contingent liability. Here the answer is, contingent liability should not be recognized, they should be disclosed in the financial statement. So contingent liability, it cannot be recognized, only it will be shown in the financial statements in the footnotes, that is notes to accounts. And the contingent liability is need not to be even disclosed if the possibility of outflow is remote, that is less than 10%. So if there is a contingent liability and there is a possibility of less than 10%, so you should not disclose in the financial statements. And now a contingent liability or a provision can become contingent liability based upon the situations. Now in the last we are going to see what is the meaning of what is the contingent asset. A contingent asset is a possible asset, the existence of which will be confirmed by the occurrence or non-occurrence of one or more uncertain future events not in a control of enterprise. So there is a contingent asset, if it is possible, the existence of which will be confirmed, it is based on the confirmed on the occurrence or non-occurrence of future events. So it is treated as a contingent asset. And contingent asset should not be recognized, and it should not be even disclosed in the financial statement unless it is virtually certain to be received. So if there is a more possible to receive, that is like 100%, then only you should disclose in the financial statement. And contingent liability also cannot be recognized, only it is shown in the financial statements of the balance sheet. With this we have completed accounting standard 29. Thank you.